So I bought some FICO stock. I didn't have time to talk about this one last week. So in today's video, I'll be covering why I bought some FICO stock and why I think the company is a decent buy today. So for FICO, the company is down around 29% year to date. It is currently trading at a 55 times of earnings. I bought this stock a bit closer to $1,300 a share. That was when I initiated my position. And for FICO, it looks like a decent opportunity today. So this is the entire system, the entire mortgage origination system in the US. So for example, let's say if you have a consumer that wants to get a loan, let's say he wants to get a housing loan, he will go to a lender, and then the lender will go to a credit bureau, which will tap on FICO to get a FICO score. So your Equifax, your TransUnion, your Experian, they're sort of like a middleman, and FICO is just wholesaling their formulas, algorithms to all these different credit bureaus. So once that happens, your credit bureau will generate a credit report and then they'll pass it on to your mortgage lenders, which will assign an appropriate interest rate to the loans that your consumers are getting. And then once your mortgage lender lends out the money, they will sell all this debt to your government-sponsored enterprises like Fannie Mae, like Freddie Mac, who will buy this debt and then package it into sort of like a stock or an ETF and then put it onto the markets where people can buy them. So for FICO, the company has been incredibly aggressive when it comes to the price increases. So if you were to compare the price from 2018 to 2025 today, although on nominal terms it's only up around $4, on percentage terms it is up around 800% already. So that is why the FHFA is being alarmed by this price increase. And for FICO, the price increases is expected to continue this way. They are expected to increase prices between 15 and 20% over the next few years as well. So for FICO, this is why the company is facing headwinds today and facing brand image problems. So people are saying that FICO's monopoly is living on borrowed time because they're increasing prices so aggressively that your consumers are pushing back and authorities are having to put in place regulations to try and curb this problem, to try and introduce competition into the space so that FICO can slow down the price increases, FICO can stop hurting the consumer, and that is the narrative that is being pushed out right now. So another company that I would like to draw parallels to is this other company called Intuit. So Intuit in 2022 actually faced a similar problem as well. So their brand image was quite bad at that time because number one, they were accused of trying to force people into paying for their paid subscriptions. Number two, they were increasing their prices at a rapid rate, and this led to the stock dropping around 24% over a span of a month. So for Intuit at that time, they were forced to refund around $140 million to low-income TurboTax users. So price increases and getting people into paid subscriptions actually led to this FTC investigation and this subsequent ruling for Intuit, which was what led to the stock price decline in that period of time. And if you were to draw comparisons to FICO today, we're seeing something similar. We're seeing regulations coming in. We're seeing the brand image being sort of like hurt. But over time, all these different brand image problems will settle over the next few years. So for FICO, I expect the company to continue increasing their prices like what they've done over the years because it is still a very small portion of the entire loan origination system. Besides that, VantageScore will probably have limited competitive edge against FICO because all your mortgage lenders, they have no reasons to switch out of FICO. They will simply pass on the price increases to your consumer, so they are not affected. And they've trusted FICO for over 20 years, so it is unlikely that they will switch out of this one. So for FICO, I feel that the fears are overblown right now. VantageScore will only threaten around 20% of the entire score's revenue. And so if let's say they take a 10% share, that will be a 2% hit to their score's revenue. So it is nothing substantial at this point, and that's why I think the sell-off has been overblown over the past few months. So for FICO, this is what the CEO actually came out and said. So the CEO said that we are not aware of anyone moving to VantageScore since the announcement. There are significant challenges kind of at every step of the way. With the FICO score, which has been in place for over 20 years, virtually every participant in the industry has built models and infrastructure around that score. It's the only score that has actually been in use, therefore for which we have data going through a full economic cycle, including 2008, the downturn. So what he is saying is that there is high switching costs in terms of your mortgage lenders to switch away from FICO because FICO is so deeply embedded into all this infrastructure, into all the systems that they have already built out. So this CEO was actually the one that discovered FICO's latent pricing power at that time. So previously FICO relied on volume increases to increase their revenue, but as soon as this CEO became in charge, he actually pivoted FICO away from just volume increases. So he started making the company increase prices, which is why the stock has been up by so much over the past few years. So for FICO, there's incredible runways for growth. So if you're to compare to your ratings, your S&P Global as well as your Moody's, so they said that as a proxy for how much value a FICO score provides, the company cited that the rating agencies charge 8 basis points on average to rate corporate debt. So applying that same spread to average US mortgage of around $375,000 results in an implied price of around $300 per score for protecting mortgage industry participants from credit and repayment risk. So FICO currently charges around $5 for each mortgage score, which represents a small fraction of tri-merge reporting costs of $50 to $100 and mortgage closing costs of $6,000. So there is still incredible runways for growth for this company if you have to compare it that way. So for FICO, this is why I think the growth that is implied today can sustain over time. So at its current price of around $1,400 a share, the company is pricing in around a 16% growth over the next 10 years. Price increases alone have been upwards of 20% over the recent years, and as soon as we see rates start to come down, this could be a tailwind for a company like FICO because there will be more volumes for your FICO score on top of the annual price increases that the company operates in. So for FICO, the revenue by segment is as such. They have around 50%, which is the scores portion, and another 50% which is under the software portion. So for FICO software, the company is slowing in terms of growth, but the company is gradually switching from on-premise to the cloud software portion. So that will help to increase margins over time. If you are to look at the margins for this FICO software portion, margins have been gradually increasing over time. So this is one portion that is underestimated by the markets, and it is deeply embedded into their score system as well. Growth is slowing, but with interest rate cuts coming in, there'll be more need for decision-making software. So for FICO, this could be another tailwind for the company as well. So that's why I initiated a small position into FICO. Hopefully the stock drops a lot more so that I can add more to this position. I'm also interested in Copart, interested in HCC. So hopefully all the stock drops together so that I can add more to all of them. So if you are to look at FICO's metrics, I mean the company's metrics are just incredible. So ROC of 80%, ROIC of 40%, ROA of 30%. It is almost unheard of for any single company to have such amazing metrics. I mean, the only company that is doing something similar is probably Nvidia. So that's why, in my opinion, FICO is a decent buy today, albeit its high valuation. I think the company is looking decent for a starter position, and that's why I added a small portion of my portfolio into FICO. Next portion, I'll be covering some of the earnings this week. So the major earnings will be on Wednesday as well as on Thursday. So on Wednesday, we have Nvidia reporting earnings, and on Thursday, we have another company which is Ulta Beauty reporting earnings. So for Nvidia, I mean the markets are probably expecting Nvidia to beat earnings again. But if you were to look at Nvidia's earnings history over the past few quarters, the beats are gradually declining over time because the company is having a larger base to deal with. So for Nvidia, it is currently trading at a 60 times earnings. I think the company will probably beat earnings. The whole market is expecting that. But the problem is how much will they beat earnings by? So if you're to look at the capex for all these different other Mac 7 companies, they're expected to increase capex this year and next year as well. So this is a tailwind for Nvidia overall. All the capex money is basically going to Nvidia. So for Nvidia, they will probably have decent earnings again, but the stock price could react otherwise. So that is an interesting one on Wednesday. The other company that I'll be talking about as well is Ulta Beauty. So Ulta Beauty year to date has done extremely well. It is up around 23%, currently trading at a 20 times of earnings. So for Ulta Beauty, the company has incredible metrics and the company has a story pushing it behind right now. So first of all, the company is trying to go global. They were planning to expand into Mexico using their current brand name because in US, they're facing sort of like saturation already. I think this is a decent move for the company. It could definitely see a re-acceleration in terms of growth if we see more international expansion, especially since the Mexico culture is similar to the US one. As for the company's metrics, this company has incredible metrics. So ROIC of 22%, ROC of 37%. I don't think there's a company, a consumer company in this space that has better metrics than Ulta Beauty, and that was what made me interested in the stock last year. Last section, I'll be covering some messages left in the comment section below. So the first one is talking about a portfolio. So he said, here's my portfolio, $75,000. So he has United Health around 24%, Google around 21%, Tempus AI around 9%, Novo Nordisk around 8%, BYD around 5%, Hims and Hers around 7%, cash at a 26%. So I think this portfolio is incredibly concentrated, and for me, I don't know enough for a lot of these companies. So I'm not too sure what Tempus AI does. I'm not too sure what Novo Nordisk does. I mean, the pipeline is incredibly complicated. BYD is a decent company in a competitive space. Hims and Hers has a complex business model that a lot of retail investors will try and simplify. So out of these 6 stocks over here, the only 2 that I own is United Health as well as Google. I think this is an incredibly concentrated portfolio, so be careful with that. But of course, I see massive upside in companies like United Health as well as Google. So it is a well-positioned portfolio as a whole. Next comment it says, coming from someone in the semicon industry, I echo what some of the comments have mentioned regarding ASML supply chain monopoly, especially lens with Zeiss. There's a reason why big semiconductor equipment manufacturers like Lam, TEL, AMAT has not dared to compete with ASML in the EUV space for the last 2 decades. It is nearly impossible to compete with ASML for high-end EUV machines. And then he also said that China can and has developed more lower-end EUV machines, but to say it will compete with ASML is a far stretch. What you should be focusing on is why ASML is unable to scale at an exponential rate. Dive into how long lead times for machine delivery for ASML impact fab equipment forecasting and ASML own manufacturing bottlenecks. If ASML can't scale revenue exponentially, then despite increasing revenues year on year, it won't be able to have massive stock price increase. Definitely still will be in an uptrend as demand from AI and semicon for the next decade is already set in stone. So I don't disagree with this comment, but for the China one, it is impossible to know whether or not China already has a machine in place. I mean, I've spoken to people in the semiconductor industry as well. They've worked with ASML personally, and what they've told me is that China is probably cooking something up already. So that was what made me a bit cautious about this company. They don't hold the stock, they don't short the stock, they don't buy any stocks, but that was what they told me. As for ASML's ability to increase their revenues, the problem with ASML is that the company's machines are too incredible, they're too good, and that's why they're not wearing out. And so for ASML, it is not a direct beneficiary of AI unless the complexity increases, because ASML's machines, they last for more than 30 years, so there's no reason for someone to buy a new machine if there's already one that's operational, unless the complexity, unless your little intensity increases over time. Thank you so much for the input. I hope you guys have found this one useful and invest.